The first question is, given that real estate companies are really slow to adopt technology historically, why real estate and why now?
So I'll take a crack. So from SoftBank's perspective, part of the reason we're looking now into the real estate industry is because of all of the investment work that folks here in this room, some of the earlier stage investors, the trends that we've seen play out over the course of the last 5 years with the magnitude of capital that's come in to help to incubate, nurture, and grow a lot of the businesses that are here today. And so from a later stage investor profile, part of the reason now is it's the track that all of the other players in the ecosystem have laid over that period of time to help create businesses that are large enough at a scale that starts to attract the type of capital and attention of a investor like SoftBank.
Sure, I'll chime in as well. So, I think over the past 10 years, we've seen a plethora of startups and new business models generally throughout every sector in the economy. And so real estate, you've seen a bunch of new business models, including our own. And I think the novelty of these new business models coming in and kind of changing a really legacy, traditional, a business that's not really changed in hundreds of years has increased excitement, and there's like a virtuous cycle there where more founders join the space, more investors chime in as well. And then I'd say a few more things. On the hardware side, we've obviously seen the miniaturization and lower cost of sensors, and a lot of real estate being physical space, and the ability to track and capture data on how people move throughout space, I think has been valuable from that perspective.
I think the recent surge in real estate tech market, or prop tech, has really been explained by two primary factors. The first is simply just the surplus of equity capital that's flooded the market over the last decade. I think we can observe that in a more resource-constrained environment of a decade ago, the capital and the talent both flowed to areas of the economy that were perhaps more obvious or more natural opportunities for venture capital, like software. But over the last 10 years, with the surplus of capital that's been in the market, there's been an opportunity for some of that market capital to overflow into areas that have traditionally been overlooked, and real estate has been one of those areas. I think the second reason that there's been a recent surge in prop tech investment is frankly that there's no other choice. There's an inexorable trend towards technological disruption across verticals, not only in real estate, but all verticals. And so I think that companies like Compass and Open Door and Conterra, many of which have been funded by our friend Justin here, are really giving the incumbents in the real estate market no choice but to innovate alongside them and to think about how they can reimagine their own businesses to keep up.
I guess the only thing I would add, Glade Brook is a pure growth equity investor, so we don't do venture investing. And we're starting to see businesses get to that growth stage where they're a little more exciting for us. Look, it's a $15 trillion market. It's a freaking huge market. And from a technology perspective, probably real estate and healthcare are the farthest behind. I mean, so much real estate is still done on paper. If you think about, SaaS or tech platforms, there's really one big player. It's CoStar. They're doing $1 billion of ARR. And it kind of reminds me of the financial services, the buy-side industry 15 years ago, where like Bloomberg, no offense to CoStar, CoStar is an awesome product, but Bloomberg dominated everything, and then you had smaller players come in like FactSet or PitchBook that were able to find niches within certain parts of data and with certain customer bases and scaled really quickly. So I think we're right on the cusp of seeing some breakouts on the information data side to help make everyone's jobs easier and less paper-based.
I think you're also seeing, just like in a lot of other industries, full stack solutions start to emerge in a much more meaningful way. And I think those solutions tend to be a little more capital intensive than the traditional, very capital light businesses that have been funded oftentimes through venture capital in the past. And so I think that's another thing that's been an attractant, because the capital availability is there, but the capital need is also there in a much more meaningful way.
So you all seem pretty optimistic that the adoption rate is going to pick up quite significantly in the future. Is that fair? So is
Yeah,
that fair?
I would just say I think what JP touched on, the analogy in other industries really does, I think, hold. You look at SaaS 1.0 and looking at a lot of the go-to-market pieces of software there, Salesforce dominating that kind of era, and then there's a transition to point solutions that would, with certain feature sets that would help you improve upon one user experience across these point solutions. And then again, I think consolidation to workflows. And right now, a lot of things in the real estate world still are paper-based, and we're just seeing that first set of platforms emerge. And it's just inevitable that those platforms try to do a lot at a very kind of skin deep level, and you'll find point solutions that do things a lot more deeply, and then those will be consolidated. And I think there's going to be a cycle here where we emerge from the 1.0 of real estate tech into the 2.0 pretty quickly, and it'll only be an accelerating growth curve.
Got it. So given all of this, and that you're diversified across numerous different industries, many of you, what do you look for in a CREtech company? So what do you find attractive now in a company today?
I'll take the first shot at what we get excited about. We look for businesses that have proven their fundamental core competency, the core basis for what they're building, and that it's super scalable. So it has the ability to grow significantly, and as a growth investor, we put money behind it. And simply said, businesses that tend to win are better, faster, or cheaper. And I can give some examples of businesses like that. If you have one of those factors, you probably won't scale quickly. If you have two, you have the opportunity to capture a huge amount of market share. If you have all three, that's when there's real opportunity for value creation. And it's rare, but when you find them and combine that with secular tailwinds that already exist in this market, it becomes super exciting.
I think speaking for Bain Capital Ventures, it's easier to define what we don't do in prop tech as opposed to what we do, which is much broader. What we typically won't do is invest in companies that are incredibly asset intensive or capital intensive and that really defy the traditional model of venture capital investment. Bain Capital, the parent, has a real estate asset entire team that actually manages a multi-billion-dollar portfolio. So we leave a lot of the asset management to them, and we're instead focused on more of the asset-light disruptors in the space, which typically fall into three categories for us that we look for. The first is companies that are in some way transforming or easing the friction around transactions in commercial and residential real estate. So we have a very deep fintech practice. We have a robust portfolio in that area. So for us, real estate tech, in many cases, is a natural outgrowth of that, where we're finding companies that are approaching the transaction or the payment associated with real estate in a novel way. We're really excited about those companies. One example is Ribbon in the residential market. It's an alternative financing solution for home buyers to make cash bids who otherwise can't do so based on their own financial liquidity, but Ribbon will enable them to make a cash bid in return for a fee. So some models like that are empowering home buyers and democratizing access to real estate are interesting to us. A second bucket that we look for is companies that are developing software for various stakeholders in the real estate industry to make workflows more frictionless. I know that's very broad, but that really just means like any SaaS play in real estate tech we'll look at and probably find something interesting to talk about there. And then the third bucket is data plays. So companies that are aggregating, collecting, cleansing, digesting, interpreting data in really interesting ways, and most importantly, finding ways to monetize that data. And there are lots of examples of that in the real estate tech market as well. So those are the three areas we're most excited about right now.
I'd echo what Merritt just said around the data front. If you look back over the past several decades, there have been a number of paradigm shifts around where companies have built big businesses and where a lot of value creation has occurred. Back in the 90s, it was around personal computing. In 2000, it shifted to the internet. In 2010, you started seeing a lot more around mobility, the transition to cloud. And I think as we look forward to the decade ahead, it's going to be the businesses that manage to have defensible advantages around data and have an application of artificial intelligence across that data to bring the most insights and advantage as possible. And so I think that dimensionality of data as a strategic advantage and how you leverage as effectively possible is the common thread across not just all of our real estate investments, but all of the investments that we're making today.
So obviously from an M&A at a strategic, we come at this from a different lens. We're not making acquisitions in a vacuum. We're only making acquisitions to further our own kind of corporate strategic objectives. But some of the themes that resonate, and I think hold true for us as well, are workflows rather than point solutions, data and intelligence, and I think the ultimate outcome of those things is understanding how people use space. So anybody who can offer us insight into that in a more passive way as opposed to having to manually do it or do it through hiring of consultants, and then improving kind of the future, what we care about, the future of work and the way space plays a part in that. Very broad kind of themes, but I think there are a lot of opportunities within those broad umbrellas.
Great. So over the course of the past 5 years, the growth in this space has been almost exponential. So thinking about that, where do you see the future in the next 5 years of it going? Is it collaboration? Is it consolidation? Is it obsolescence? Do you have any views on where the future is going?
I'll take I think you can take that many different ways. I'll just kind of point out a couple of things that I think we think about. Yeah, I mean, again, I think from our perspective, future of work is important, and I think there was a lot made of work from home a long time ago, or not too long ago, a few years back, and then decentralization of the workforce continues to be a thing. But we also find, and this is from bias, we also find that folks engaging in physical space, community is important. And so I think there's going to be just a lot of alternative ways of using space that we don't necessarily think through today, whether it's in the office environment, the retail environment, the restaurant environment. I think those are going to be, those are going to drive a lot of the ways we consume and utilize real estate in the near-term future. And then, I think you kind of mentioned collaboration, consolidation. I think it'll just be a question of how do people and investors think about real estate? Is it, a 5 to 8% yield business, or is it a platform off which you can derive higher growth, higher margin businesses? And so you'll see, I think, from the more mature players continuing to see divestitures that let them focus on their core strengths, and at the same time, the one-stop shop CREs will probably continue to consolidate, and so those are probably, from the M&A side, trends that we see.
I think we're going to see an acceleration. I think the secret's out. You just have to look around this room and see how many people are here to realize that technology and its application in real estate and the potential, and not just the potential, but the inevitability is here. And so I think over the next 5 years, I think there's already been an acceleration. I think that's going to continue and probably even further accelerate. Like the secret's out, everyone's here because they recognize the importance of that application of technology.
I think two themes we're really interested in exploring and have been for a while are, one, the democratization of access to real estate as an asset class, and two, the disintermediation of the real estate transaction. So I'll limit my comments to the commercial real estate side. It's a pretty different story on the residential side. But we're interested in platforms that will enable retail investors to access commercial real estate as an investment opportunity. In today's world, they're, for the most part, shut out of those opportunities unless you have a net worth that enables you to get access to private banks and services from the likes of Goldman Sachs, JP Morgan, and others. But many investors who would love to have access to commercial real estate investment opportunities can't. So we're starting to see a handful of investing marketplaces and other platforms that are trying to, through various means, expand access to real estate investment. And I think the buzzword in this area is really blockchain and what that can do to sort of serve this mission. But it's not the only way. There are actually a lot of non-blockchain enabled companies that are trying to do this as well. and I think they're very much linked to the disintermediation of the transaction, which is the second theme I mentioned. And I think when we think about disintermediation, it doesn't have to be as disruptive as what Opendoor is doing in the residential space, where they're going direct to the seller. In the commercial space and the residential space, it may just mean that transactions become less intermediated over time, or that intermediaries can extract less value from the transaction than they have historically. And we're seeing that certainly in the residential space, partly due to the pressure that Opendoor is putting on the market, but similarly starting to see that in the commercial space as well, where there are platforms like Yield Street, which is a quite early stage company that's charging a much lower fee to match buyers and sellers of alternative asset classes. So that's broadly a theme that we're really interested in, and if there's anyone in the audience that's working on projects along those lines, would love to connect with you after.
And at Glade Brook, we're really focused on the software side of the market and data and big data, particularly around transactions. It's amazing to me that the majority of property level data is still sent around in a tear sheet in an email to like the people that you have on your email distribution list. CoStar has data, but a lot of the brokers that we speak with say it's either not great data or it's incomplete, and they rely on just like what they have in their head or what they're getting in email. So as simple as just deconstructing email data and consolidating that into something that's more of a database. These are early days, and there's tons of opportunity relative to what we've seen in other parts of in other industries, 5-10 years ago.
So we're hearing a lot about software and data. That's a big theme here. But are there any other areas that are really exciting to you? So outside of software and data, Katera obviously is a company that you guys looked at. I know there's other things going on out there, but is there something that just excites you, either personally or as an investment?
Well, I've one that's really neat. It's called SenseTime. It's an artificial intelligence business based in China. And what SenseTime focuses on is using artificial intelligence to understand human faces effectively and being able to track them. And what they're doing in the retail commercial area is really neat. They'll set up cameras and they'll be able to track unique faces coming in and out of the door of different stores. So if you're like Dick's Sporting Goods, you can have a camera and see, how many unique visitors you had that day. How many of those visitors came, at a different time and or came the week before, and using that data to kind of figure out what promotions get people excited and what type of buyers you have. It's all anonymous, which is good. The privacy laws in China are a little different than here, so they have a little more capability of using the data. But I think that type of artificial intelligence will be coming across the shore in a relatively short order.
For me, the answer is title insurance. Very excited about title insurance. And never thought that sentence would come out of my mouth, but there it is. And if you look at the opportunity, the dollar opportunity associated with title insurance and the number of people who are tackling that sector and the problems inherent in it, there's a huge disconnect there relative to what we've seen in other spaces. So $25 billion market cap, $10 billion market on an annual basis, most of which is on the residential side. About 80% of that is residential. However, I could probably name 5 startups that are trying to innovate in the title insurance space in any meaningful way. So there's a lot of opportunity there. I think for a lot of reasons, it's sort of been overlooked historically. There are just lots of manual processes inherent in title insurance, an enormous amount of inefficiency. So for anyone looking for a new project or to start something new, I'd highly recommend taking a look at that space.
Do you think it goes blockchain? Do you think blockchain is the solution there?
I think it could be. It could be. I mean, what Mike Cagney's doing with Figure is certainly tackling that problem. First American just announced that they've developed their own blockchain for the title space. So, but I think it's all very nascent efforts. I think the challenge with using blockchain in the title space is there are a bunch of different ways to go about doing that exactly, but you have to get a lot of stakeholders to use the same blockchain. So there's always going to be like a chicken and egg and like essentially network problem with launching any blockchain solution. So most of the startups in the space aren't actually, or at least the ones we've spoken to, the ones that have raised a lot of venture capital, with the exception of Figure, I believe are not actually trying to solve the problem through blockchain. They're trying to take more remedial steps, frankly, to innovate and pick off the low-hanging fruit.
I think real estate as a service, and WeWork's a great example of that. I think there's many more applications of that to be explored, and companies that'll continue to innovate in that space. We've seen that with software, we've seen it with infrastructure, we've seen it with mobility. I think that's a trend that is spreading across multiple ecosystems and segments of our economy. I think real estate will continue to see that with WeWork on a co-working basis, companies exploring that on a short-term rental, on a living basis, storage, retail. I think there's a lot of opportunities for more flexible solutions in real estate to end users and consumers and tenants. And I think that we're just starting to see the surface scratched on that front.
So I think you've seen extreme personalization and customization in the online world, and we haven't quite seen that yet in the offline physical world. And this again coming, I think, with a bias. Having experiences that are personalized to your day-to-day routines, I think we're still kind of at this early entry point. We have smart speakers, we ask for certain things on demand, and we try to make our days more efficient that way. But I think there's going to be a lot more passive recognition with the devices you carry on your phone, around access control and security. If you think about your productivity during the day, probably around AV and collaboration and communications tools. I'm really excited to see how we can use our physical environments to customize and personalize to your day-to-day routine.
Rohit, I have a question for you. So as a WeWork investor, I feel entitled to ask and can be direct. It feels like WeWork's M&A has been a little bit like all over the place. Is there something that like defines what you guys look for when you're targeting acquisition? Or is it just kind of like, depends on what Adam wants to do?
So I heard a little bit of a humble brag there first. You're a WeWork investor. But yeah, I mean, look, I think having done corp dev at a few different companies previously, there's a lot of ways to source your deals, right? There's working with your investors like yourselves and the relationships we cultivate, working with bankers. There's also kind of your inbound business leaders having their own views on where they want to take their business. At a strongly founder-led company, I think the founder has very strong views on like what we want to do next. We have like pretty strong pillars, I think, around where we're doing M&A now. It's probably taken us a little bit to get there, but we have maybe call it 4 to 5 strategic themes where we spend our time. Our core business is our core business, but there's ways to, I think, augment experience and member experience at those businesses and actually service a lot of our enterprise customers. You'd be surprised about the things that our enterprise customers come to us for now beyond real estate. And so a lot of times the way to answer that is either going to be through, either a partnership or, the things that make the headlines typically are acquisitions. And so it may for a while look like we're looking at a lot of different spaces, but, we have peoples and processes that keep us honest, so I'll leave it at that.
So I guess we have just a couple more minutes left. So one last question, which I find very interesting, is how do you see technology changing the way that you invest, just how you choose investments? Is it artificial intelligence? Do you look at crowdfunding? Do you look at blockchain? How do you feel the work that you do is going to be changed by technology?
I'll kick it off just to give everybody time because my answer is easy. We definitely just look at our larger corporate strategic objectives to make decisions on acquisitions and investments.
I think for us, it's more like evaluating those technologies as places to invest in backing companies that have the ability to generate a lot of value through rolling out that technology. For us, like the blockchain stuff is still too early and unproven. I actually think artificial intelligence is much closer, and and then just rolling out software platforms that enable the industry to work better, faster, cheaper is right on the cusp beyond the platforms we're already using today. So there's going to be a lot of innovation there.
I would say for people, for VCs who purport to be very data-driven in their decision-making and expect companies they invest in to be led with data-driven decision-making, it's sort of ironic that VCs, and I include ourselves in that statement, don't necessarily leverage data to the fullest extent in identifying and sourcing opportunities. So one problem that I find pretty interesting is how can we as investors use data and alternative sources of data that may not be revenue figures year to year, but other sources of data to signal which companies out there are gaining momentum and where should we be spending our time. Because I think the biggest challenge we have is time management and figuring out how to prioritize all the different companies out there, the hundreds of thousands of companies that we could potentially invest in. And so I think we could probably do a much better job leveraging alternative data sources and interpreting it in a more systematic way to identify investment opportunities out there. And I think that's something that the venture capital industry, in my opinion, has just not done very well historically. It's been very relationship-driven, very driven by hearsay and by localities like San Francisco and Silicon Valley, where you can get a lot of momentum because of proximity. And I think if we were to use data, we could probably democratize that decision-making process.
It's funny. I think that's probably sage advice as well to some of the companies that are trying to leverage that data. I think it's easy to say you're heading in that direction. It's also very easy to start to revert to old habits because they're easier and everyone gets busy and there's just a way of doing things that becomes very easy. So I think that the promise of what artificial intelligence and data can bring to the industry, it's not as easy as it seems. I know it's easy for us to sit here on stage and say, yeah, just get a bunch of data and go mine it and then ta-da, competitive advantage. But I think what you were just sharing, Merritt, is a good testament to the fact that this is not an easy journey. It's not going to be had overnight. In response to the next 5 years, I would go back to what I was sharing earlier and which JP shared. I do think it will be the application of data and artificial intelligence that helps to create that advantage over time. And it will be a journey, but I think that going back to the earlier part of this panel, it's the capital, the commitment, the acknowledgement that the industry has arrived and is starting to absorb and recognize the need for that application, which gives me confidence that we'll see tremendous progress in the years, 5 years, decades ahead.
So you're not looking to get out of real estate anytime soon. You're sticking with us, everybody here.
And,
Awesome.
and the only other thing I'd add is there's debate around real estate valuations for tech companies. I always meet people and they're surprised by what CoStar is valued at, surprised by what WeWork is valued at, just to start. And look, I think at this point there's an agreement on the buy side that CoStar should trade like a SaaS company and at a SaaS company multiple, which is like 10 times plus revenue. And WeWork should trade like an ultra high growth business services company, which there aren't any. So then the next thing you have to look at is tech, because it's the only other thing that grows like WeWork does. But I think the groundwork's now there for the next generation of companies to not have that question around if we build something growing, quickly that has great economics, what's it going to be worth? The answer is going to be worth a lot.
Just to echo that point, I think there's always been a concern around what's the exit, right? But it's no longer limited to the world of real estate. Like Amazon invested in a prefab company recently. I think all corporates are seeing real estate as a vertical that's inevitably part of their core needs, right? So I think there are going to be potential to exit into players that we didn't initially see as potential acquirers.
Well, this has been fantastic. Thank you guys for taking the time. I think it's a wrap now, so thank you very much.
Thank you.